Hey guys, what's going on? In this video, I'm going to talk about what are stock options and what are the different types of stock options. So before we go any further, my name is James Mason. If you don't already know yet, I am one of the founders of Transparent Traders. You can check us out on Facebook. The link will be in the description. This is lesson 1 in my free stock trading course. If you need to know how to trade, just in general, I have another course just for, it teaches how to trade, shares. And it's actually in the playlist on my YouTube channel. So, let's get to this. So, a lot of people, beginners, if they don't know about options, they're probably going to, kind of look at this thumbnail of this video and just think, that's too simple, I don't need that. Well, the thing is, if you don't know, you're going to struggle. There are actually 4 different types of contracts for options. And, let's just go ahead and get into this. So, alright. So, I use TD Ameritrade Thinkorswim's platform. And we'll just go through here since the market is not open. I can show you actually right here, but I'm going to show you some other things as well. So go up here to the on-demand feature. This is basically like it's simulated trading. So it's just trades. Well, it's the market that has already been recorded in the past. So you can actually go up here. If you don't know about this, this is actually pretty cool. You can go up here and just change the date and time to whenever and just play those tickers out to see how you can do by backtesting these theories. And I would actually recommend, after you complete my courses and everything, to try all of that out, and you'll be able to see for yourself before investing, real money. That's always best. So, all right. Let's go up here. So first off, if you don't know where to find how to trade options or where to even look at them using the Thinkorswim platform, come up here and click on trade. So just make sure this is clicked up here, all products, whatever, and obviously we're not getting into Forex or futures or anything like that, but you have these other options up here as well. So click on trade, make sure it's all products, and here we go. So for this date and time, this is the contracts that are playing. So let's just start with, we'll just click on this right here. So let's start with the calls. So you have long call options and you have short call options. So when you are looking at these option contracts right here, the one that says ask, these are long call options, meaning that you're looking for this stock value to go up. On the flip side of it, right here on the bid, these are short, call options. And you're actually looking for this, for the stock price to drop. So, a lot of people who are not experienced with options, they just hear someone say calls, and they think, oh, well, they're going long in this, they want the value to increase so they can make money and all that stuff. And most of the time that is true, because most people, trade the long side. But, so this long side right here, this is a bullish trade that you would be taking. Over here, for the bid, this is a bearish trade. So that's actually the 2 sides for the call options. So let's jump over here before we get into this any deeper. Here's the puts. for the ask, these are the long puts. Now, for the long puts, we want the value of the stock to go down if this is the trade we are taking. Now, don't confuse it, because I said long put with a long call as it being the same. They are opposites of each other. So, this one is opposite from this one, this whole row, these rows right here. Same is true for these rows. These are opposite of each other. So right here for the bid for puts, this is actually a bullish trade. Now, this is where a lot of confusion starts coming in for a lot of people, because you technically have 4 different ways that you can trade contracts, for options. And that is to either be bearish or bullish with calls, or bullish and bearish with puts. So the next thing I want to talk about is why is this side this like purplish color, and this side the same color, and then black right here, black right here. So if you come up here, you will see here is the stock price, 273. If you come down here on this side right here, this row, this is the strike price. Basically, the strike price is where, for you trading options and just trading option premiums, this is where the difference in you making money and losing money will come into play, So we'll start off talking about long calls. So if you look at the price again, 273, this is the strike price, 273. Well, it's technically 273.51. So right here, this is 273. So this first row right here for both sides, this is actually called at the money. So you'll see it abbreviated ATM. Now, you can see why it's at the money, because it comes up and it's meeting this value right here. So this is the first row of, technically, even though it's at the money, it's still, it's still in the money. So, for instance, right here, let's just say, okay, we'll just say, we buy one right now, and let me show, okay. So let's just say we buy one right now, and technically this is, off a little bit. I guess it's not actually 100% accurate with the market. So this row should actually be, this purple color as well. But, so anyways, we'll just say we buy one right here for the strike price, $273.50. The price right now is $273.51. So this, level right here, which actually should be at the money, and the reason why it is at the money is because, it's 273.51. It is past that strike price of 273.50. So that's how this works. If the value of the stock goes past the strike price, it is considered in the money. And it should have this purple, layer going over it for that level. Same is true over here. So for this one, for instance, $273.50, and if this price dropped and broke $273, then this whole layer would turn this purple color. So that's kind of how this all works right here. So let's see. So let's talk about, why would somebody trade, either side of these? Why wouldn't they just have it, calls or puts, and just trade that way? So basically, this right here, the long calls, if you meet whatever requirement for your broker, and that's what a lot of this is going to come down to, is the individual requirements for your broker to be able to trade these. For instance, with TD Ameritrade, I think it's a $2,000 minimum for the margin account. I honestly can't remember. So, and also I think it's like a tier. I think the minimum is like a tier 2 account. It might be a tier 2 advance. So again, that's something, if you're using TD Ameritrade, you have to go into your settings and on the website and to look that up to see what tier that you fall in. So, with a tier 2, just the normal standard tier 2, I know for sure that you can, trade these long sides of these options. So, basically, you buy these contracts and you trade them. Now, for your investment, the only thing that you could potentially lose here is what your investment is. So if you have $1,000, buying these long calls or buying these long puts, the most you could lose is $1,000. And a lot of people, when they hear about options, they always think of all of this, inaccurate information, such as you can lose all your money, you can lose more money than what you traded. Now, that is true, but that is not, the whole entire story. So, again, let me just say this to be clear. The long side right here for the puts and the long side for these calls, the most you can lose is what you have invested. Now, with that said, if you go over here to the short side for the calls and the short side for these puts. So over here, this is what you call, a contract writer. When you hear someone talk about, someone writing calls or someone writing puts, these are the guys right here. And we'll talk about strategies and that stuff in later videos. So right here, this person, when they write this, they either have the amount of shares to back up each contract that they're writing this contract for to sell to you, for your trade, or they have the money in their account to cover it. And when they take this position right here, if they have the money in their account, their broker will, their broker locks that money in place so they can't spend that money, just in case if they lose it, you can get paid, or whoever buys, the receiving end of this trade actually gets paid. So, that's how all that works. Now, these people over here, there's only so much money that they can make per trade. But they can lose an unlimited amount. Now, a lot of people probably be thinking, why would you even want to risk this? Well, to be honest with you, the percentage, for them to actually, pull off a successful trade is a lot greater than, trading just a normal single leg in options. But you also have a lot more at risk. So I'm not going to try to get into, the theta and all that right now, because that will be for another video. But, so for these long positions right here, for like the calls and the long positions for the puts, you buy these contracts and they have so much time left. So for instance, if you look at the date right here, this says November 1st. Right here it says November 2nd. And at the beginning of the video, you saw all this. These are the expiration dates. And, you'll just pick on the expiration date that you want. And it's always best to buy time, but again, I'll talk about all that later. I'm trying not to, cross videos over into each other. So you'll make sure you buy enough time. But anyways, the date for this video, because this is on demand right here, I went back in time. Says November 1st, and this one expires November the 2nd. So as this approaches the end of the contract, it's harder for the people who are long in a position to make money, just because these contracts decay. Now the opposite happens right here for these contract riders. The closer it gets to the expiration, the more money they make. But at the same time, they're limited to how much money they can, make in this trade. Now, with that being said, let's go ahead and take a look at just some, potential profits, I guess. Obviously potential for just whatever this may be, just for this video. So here you have it. If you wanted to buy, I'll show you this again. If you wanted to buy a contract on Thinkorswim, if you want to buy calls thinking that the price is going to go up, you just simply find the strike price that you want, and if all this information ain't here, you can actually click right here in the middle and find, it breaks it down like that. I like to have them all on so I can see everything. Like, even though I would never buy up here just because it wouldn't make no sense, I personally like to see it. So I would click all right there, and it would bring up everything for these contracts. I would find the strike price that I wanted to trade at, and you just simply click on it right there. This box will pop up, and you put however many contracts that you want to buy right here, and just so you know, like this right here, this is not controlling just 10 shares. Each contract for every one of these right here controls 100 shares. So this technically right here controls, if we kept it at 10, this is actually controlling 1,000 shares. That's a lot of leverage. Now it's nice when your trade goes in your favor. It's not so nice when you make a bad trade. So we'll just keep right here. So 10 contracts. This controls 1,000 shares for 10 contracts. Now, does every contract out there control 100 contracts? I just want to say this real quick. No. I would say probably, I don't know, 98, 99% of them do. But there are some weird other contracts out there that control, less, like 25, things like that. Again, it's rare, but I will show you. Oh, here it is. It's not really something you have to worry about too much, just because 98 to 99% of contracts control 100, but still, you should know it. So if you look, right up here, you see, this value of 100, and that's exactly what that means. That means this controls 100 shares. The other ones would say, 20 or whatever it may be. Now, while we're looking at it, why did he say weekly? Well, that's simply that. These contracts expire on a off week within the month. So technically, like, this one right here, this is the third, this one that doesn't say weekly. This is the monthly contract. This one right here, it expires the third Friday of each month. So you have this one right here. This is the third Friday of November. Come down here to December, third Friday, and January, third Friday. So that's how that works. Now the weeklies, obviously, weekly. Now, some people get confused that if you trade these, do you have to trade within that week? Oh, absolutely not. Like, if it's this week right here, you can go down here and trade this week. It doesn't matter. The thing is, it's going to come down to how much you pay for the option premium. So, and that will obviously be for another video. So, that's what weeklies mean, and non-weeklies, which would be every month. So every third Friday. These are just your standard contracts. So let's go back up here. All right. So now that we understand that each contract controls 100 shares, I'm just going to keep 10 in right here. So we want to control 1,000 shares of this ticker right here. This is the day that it expires, and it actually expires. It expires at the end of the trading day, but it actually doesn't settle until sometime like Saturday on the weekend. So, but anyways, like that, honestly, it really doesn't matter, because you need to sell this beforehand. And a lot of times your broker will actually sell it off for you. So right here is the strike price, and okay, yeah, I did click that one. Okay, so this is the strike price, and because this is a call option, since a long call option, since I clicked this one, I want this. I want the stock to keep going up in value, but I definitely do not want it to go below the strike price, because when it breaks and goes under that strike price for the contract level that you bought at, you will lose a greater value of money compared to if the price is fluctuating and you were still in a profit. So that's the strike price. This right here just says you're buying a call, and this is the contract price. So this is not actually $2.14. This is $2.14 times 100, and this will be per contract. So $214 times 10 for this example, because that's what we're buying here, which would end up being, $2,100, or $2,140. So, for a more simpler, math equation, if it was just one, then just one contract would just cost you $214 and then your commission fees. Now, over here, this is time and force. So if you was going to put in a order and you wanted this order just to stay on the market for today, you'll just keep it a day, and you'll submit it, and it will do what it needs to do. Now, if you wanted this price and you was willing to wait, you'll simply click on it, and you'll click on GTC, which stands for Good Till Close. And you can click on this, and you could have, let's just say, 4 contracts fill right now, and it doesn't fill for the rest of the day. And then tomorrow, it fills the other 6. Or it may never get filled. So you'll just have 4 contracts. So that's what that means. So we're gonna, we have it there. If you want to adjust this, you can just change the price. And when you change the price, that little lock, it actually locks, to keep it from bouncing around. And your order right here, limit order. It's always best to do a limit order. I talk about all this stuff right here in my other course. So if you need to know about all this, you need to go check out my other course in my playlist section on YouTube. Playlist 1 and 2. So playlist 1 and 2, it's the same content, it's just 2 different styles. Playlist 1 I teach with EMAs. Playlist 2 I teach with Bollinger Bands. So, before I go any further, if you don't know how to trade, just in general, trading options should not be the first thing you start trading. You need to really be able to You need to be able to successfully trade anyways. But if you start trading options and you don't know how to trade, it's just going to be bad. So, we'll get back to this. So here we are. We're just going to buy this. So confirm. And this is where this is important. And this is what I want you to see. So here we are, your confirmation box. This tells you right here that you're buying 10 contracts for this ticker. This 100 stands for how many shares it controls. This is just a weekly contract, and it expires the 2nd of November. And right here is your strike price. This, you're buying calls, and this right here is how much you want to pay for it. So if you look right here, the break-even stock price. The only time this matters is if you plan on actually exercising your options and purchasing the shares. 80% of the time, that doesn't even happen. And 80% of the time, people just don't do that. I personally don't care about purchasing the shares. I'm just here to make money off premiums. That's the truth. So, if that's something that you care about, with buying the shares, which, for whatever reason, you may have, then yes, you would care about it breaking across this. So, but anyways, for me and for the majority of traders out there, this really doesn't mean nothing. A lot of people think that you have to break this, break-even price to get past this point before you can sell. Not true at all. A lot of people think that you have to hold these contracts until expiration. Not true at all. I can buy a contract a year out from now and sell it right now. I can buy one that expires, in a couple hours, and I can sell it right now. So there's no limit on how long you can own them except for the expiration. So right here, max profit, infinite, because in this trade right here, if this stock just shoots up to whatever, you're going to make that difference. So it really just depends on how much the stock goes up. For the loss, now this goes back to what I've been saying this whole time. For the long side right here, for the calls, and this is true for the puts, and I'll show the puts here shortly. But you can only lose what you invested for the long side. So right here, $2,140, because math. That's the most you can lose here. Now, right here, this next one, cost of trade. It just tells you what, how much it cost you. And, these values right here, because this right here is just a simulated account, it's just going to be this. But this right here just states whatever your account looks like. So, that's all you got to do, and then you would click send, and it would purchase these contracts for you. So I'm going to show you the puts real quick, and then I'm going to jump to these right here, and then we'll pretty much be wrapped up for this topic. So same thing. Let me drop this down. Alright, so let's just say I think this is going to go down. So I would click right here, this will pop up, and I just want to buy 10. That's my ticker. It expires there. That's my strike. I'm buying puts. So I want this to go down, and that's why I would buy these long put contracts. And that's the price. So we're going to click confirm. All the same stuff right here. This tells you, your max profit. Now, the last one, it said that it was infinite. The reason why was because, let's just say this is, your level. We'll just say this is the level of what the stock price is. And, we're talking about the long calls again. So this is your stock price. And for it to be infinite, it can go up. The sky is the limit. Now, with this being said, because we're buying over here, we're buying the long puts. Same thing, but if you want it to go down, 0 is the most it can go down to. So right here, that is the max amount of profit if SPY would just tank and hit 0. This is the most you can make out of this trade. With that being said, your max loss, your investment is only $1,050 for right here because what you're spending. So that's the most you can lose in this trade. If you're buying the long puts here. So, and again, if you want it, you'll click send, and then you'll take it from there. Now, over here to the contract riders. Basically, your short options. So let's just say I think this is going to go down, this stock price. For whatever reason, I choose all this, and I'll talk more so about this in strategies. But, if I wanted to write contracts, I'd come here, I click this, and all this will come up. This will be red because this is the short side of it. Here we are. It says the same thing. Right here it says sell. because this person is writing these contracts. They're actually selling them first. And it's just like with shorting. They're borrowing, for shares they're borrowing, and then whenever they have to cover, they actually have to buy that same amount back to zero out that trade. Same concept right here. So, they're writing the contracts for this right here, and all the same numbers. The only thing different here is because this is a bearish trade, they just want to see this price go down. So then they'll click on this and this pops up. So right here it says that they are, or you are selling 10 SPY contracts. Same thing right here. That's your price. Max profit $1,710. The reason why it becomes that is, you spent this $1.71 times 100. You spent $171 per contract, and you bought 10 of those. So 10 times 171 equals 1710. So 1710 becomes the max amount for your trade that you can make right here. Now, max loss, infinite, because if this stock would just skyrocket, you owe everything else, and you can't trade options during after hours. So if you see this gap up, for this trade, if you see this trade gap up in the aftermarket, the pre-market, after hours, it don't matter. If you see it gap up, man, it's gonna destroy you. So to do this, you really need to know what you're doing here. Now over here real quick, same thing. This is actually a bullish trade, but you're still writing a contract, you're still shorting. So here we are, same thing, confirm, and here we go, max profit, because it's the amount you paid times the amount of contracts you have. And right here, this one is max loss. So again, because how I talked about a little bit ago, this is a bullish trade, but it goes back to hitting zero again. So that's how much you could lose, because the stock the stock value times however many contracts you have times 100. So I'm going to go ahead and wrap this video up. I know this may sound confusing, and options can be intimidating. It can be confusing, but this is why you have to take the time to learn all of this. And the thing is, you can do this, you can learn this. It's really not that complicated. It's just, you just gotta spend some time to give it a chance, to put in the effort to learn this. It's really not complicated. The thing that makes it so complicated is, you have 4 different ways you can trade this, and each way has its own way of making you money and losing you money. So, please take the time to understand this. So I'm going to wrap that up. I appreciate you taking time to watch this video. I have a lot more videos that are coming out, and I hope this course, this is lesson 1, I hope this course helps you guys out for how I trade options. A lot of these videos in the beginning, it's going to be to take somebody who doesn't understand options and to explain it to them before I actually get into how I trade. So, hit us up in Transparent Traders in our Facebook group, And please subscribe and hit the notification button so you can continue to get these videos. And I appreciate you taking your time to watch this video, and I will see you in the next one.